More bad news from Europe. Lather, rinse, repeat. Yes, we've heard this story before, and sadly it's not going away anytime soon. The latest worries are yet again in Spain. That economy in very, very serious pain right now with unemployment sky high. And now people are still worrying once again about the health of Spanish banks. Those concerns have pushed Spanish bond yields above the key psychological level of 6%. Not a good sign. You've got shares of the two big Spanish banks that trade in the U.S., BBVA and Santander, with the unfortunate ticker symbol of STD, both down sharply as well. I think any investor that really expected the European economy to miraculously heal itself really has been deluding themselves. This is a crisis much like the U.S. economic bubble that resulted in the Great Recession and this slow recovery that we've been having for the past few years. It took decades to get into the mess. It's going to take years, maybe even a decade or more, to get out of it as well. So any investor that thinks they can just not worry about Europe, they're really, really kidding themselves. The headlines may be sometimes a little bit too overly dramatic. I don't think the euro is plunging into a depression. It looks like the euro currency is actually holding up quite well. I wrote about that in my recent column on the site on Tuesday. But all that being said, Europe's economy has a lot to do before it can get better. Regulators need to do more, and until there is firm action taken to really, really get at the root of the crisis, which isn't just austerity, but actually trying to stimulate growth again, you're going to see more bad news from Europe for a while.